All right, when looking at capital gains, okay, you'll see when focusing on chapter 7 or study unit 7, you always need to take into consideration that calculation for taxable income. So we've been looking at it over the last few weeks. We've been focusing on specific line items in the actual calculation. Last week we spoke about allowances, okay, specifically capital allowances, so allowances relating to assets. This week, we're going to be focusing on what happens if something is considered capital. So, in other words, it's not part of operations or revenue, but it's actually considered capital. If it's considered capital, then you've got to follow a whole separate set of rules. Okay, so study unit 7, which is looking at CGT, this is only applicable to specific scenarios, cases, okay, where you have something of a capital nature. Okay, so something that is capital or deemed to be capital, and you have to apply the principles correctly to work out the proceeds, the base costs, and obviously the capital gain or loss. You'll then include a portion of it in the actual calculation. Right, so you do get an inclusion rate, and the inclusion rate means a percentage of the actual gain will be included as a taxable gain. Right, so you get a capital loss or gain, and you get a taxable loss or gain, depending on what the inclusion rate is. Right, so depending on what type of business you are, it could be sole proprietor or company, a different inclusion rate will apply. Right, you're obviously looking at chapter 6 in the textbook, and let's have a look at the first bit. Right, so this is some revision, something we've seen before. Just a note at the top of the page, when selling capital assets, so if I sell an asset, think about your accounting. What do we call that?
Asset realization.
Yes, okay, good. Asset realization or asset disposal. Obviously, when you sell an asset, you need to work out the carrying value, and you need to compare the carrying value to the proceeds to work out if there's a profit or loss. Remember that?
Yes.
Okay, if I'm looking at tax, I'm not going to work out a carrying value, I'm going to work out a tax value. Right, so assets that are used in production. Right, remember we talked about land, buildings, equipment, all of those larger assets that are actually controlled by the business that adds to their capacity. Those assets are good, and businesses can use them to produce goods, and they can receive capital allowances. Okay, we spoke about capital allowances last week, CA, capital allowances. Right, what happens if you ultimately, eventually dispose or sell those assets? What's going to happen? Well, this is going to kick in, okay, and this only applied post 1st October. Okay, so before 2001, there was no CGT. Right, so CGT is relatively new. Okay, 19 years is not a lot of time. Okay, actually 20 years. Okay, we're in 2021. Okay, 2021, so 20 years ago, right, October the 1st, 2001. Okay, it'll almost be 20 years. Okay, this year, October, will be 20 years. But the point is, government is obviously wanting to collect as much tax as possible. So CGT was something new that they had incorporated as part of legislation back in October 2001. Right, so why do you think they changed the legislation? Why do you think they've included capital assets as part of tax?
To get more tax, to get more funds.
Yes, and to widen the scope, okay, because if you don't tax assets that are bought and sold, you're actually losing out on income. So a taxable capital gain is something that government is using as a way to collect more tax, but also to provide a, how can I say, it's to make it similar to the accounting, because accountants obviously look at a gain or loss on the sale of an asset. So accountants have been calculating the gain or loss on the sale of an asset, but from a tax perspective, it wasn't something that was considered. But now it is obviously part of legislation, and since 2001, it's incorporated as part of the taxable income calculation. Right, so do you want the taxable gain to be bigger or smaller?
Smaller.
Yes, okay, because you're adding it. Right, so if I'm adding it to my taxable income, obviously the bigger the gain, the bigger the taxable income. Right, so ideally, you would hope to have a lower taxable capital gain to prevent your taxable income from increasing too much and then end up paying more tax. Right, so there are certain rules we need to apply. CGT is obviously important because businesses need to account for their assets, and a capital gain or loss can arise. Right, if I make a loss, what will a loss do to my taxable income?
Um, it will decrease it.
Correct. Okay, so businesses actually won't mind selling an asset even at a loss because, worst case scenario, they're going to get a tax benefit from a decrease in their taxable income. Does that make sense?
Yes.
Okay, so obviously a gain is good because you're obviously getting more proceeds from the sale of the asset. But even if I can't sell an asset for more than its tax value, at least I still end up with some sort of benefit, even if I make a loss. Right, so it comes back to what we said last week. Businesses need to be helped, and obviously government wants to help businesses as much as possible. So one of the ways they do that is by allowing businesses to take advantage of this in terms of a loss. Okay, if you sell something at a loss, it will obviously help you in terms of a tax benefit. Okay, I've just put a note here about the eighth schedule. Remember, it's new legislation. Okay, back in 2001, this became legislation, and there's now an eighth schedule in the Income Tax Act. Okay, so remember with law, okay, legislation, cases, all of that stuff, those things always change. And sometimes government can amend the rules, or they can add to the rules, or they can improve the rules. So this would be seen as an amendment, okay, something that was changed or added to the actual Income Tax Act. Okay, do you remember this? Revenue versus capital. How do we determine if something's revenue
Um,
or capital?
are you talking about the tree and the fruit?
Yeah, that's part of it. So explain what's revenue,
But
what's
there's
capital.
capital is the tree and revenue is the fruit. But I remember we also spoke about subjective and objective tests.
Yes. Yeah, so this is a recap slide because sometimes it can be a debate because obviously SARS is going to want to view everything like revenue and companies want to view everything like capital because companies get some benefit if they look at capital rather than revenue. Right, revenue must be included, so SARS would want everything to be considered revenue. Right, but there's always going to be let's say a debate in terms of what is it actually, right? Is it actually revenue or is it actually capital, right? And then sometimes you've got to apply these tests, both subjective and objective, to establish whether it is capital or it is revenue, right? So what does SARS want? We just answered the question. SARS wants everything to be what?
Revenue.
Revenue. Okay, ideally, that would be best for them, right? Because they would obviously collect the most income if it was considered revenue versus if it was capital, which the taxpayer would want, right? So obviously, there is a slight, let's say, difference of opinion. Okay, so obviously, the one wants something and the one wants something else. You might have scenarios where this would be debated and you would have to then motivate. And remember, the burden of proof always lies with who?
The person who's claiming.
Exactly, yeah. So if you're making a statement, or if you're claiming something, or if you're assuming something, or you're saying something, right, it would be your responsibility to prove based on evidence. Okay, so in other words, you can't make an accusation without evidence, right? If SARS is accusing the business of recording something as capital and it should be revenue, then the burden of proof would lie on SARS. SARS would have to prove that it is indeed revenue and not capital, if that's what they're saying. Okay, SARS can't make a statement without backing it up. Same with the taxpayer. right? If you're going to claim something as capital and not as revenue, and you're claiming that it is capital and not revenue, then you need to be able to motivate and substantiate and provide the evidence to prove that it is indeed capital. All right. So as long as you can do that, and you can, based on facts, motivate the one or the other, it would obviously be taken into consideration when working out taxable income. All right, this is also something we looked at before, a special inclusion. This was covered when we spoke about gross income. Okay, remember with taxable income, okay, we're working out gross income and then we're adding and subtracting different line items. The reason why the slide is up here is because of this. Okay, if you get proceeds from an asset disposal, that would be seen as income. Okay, it's a special inclusion. You have to include it. Right? Any recoupment would be included as well. A recoupment, we saw last week when we looked at capital allowances. A recoupment is basically the same as a profit on sale, but from a tax perspective. Okay, so when your proceeds are greater than your tax value, okay, there would be a recoupment that would be considered as part of the working calculation. Right? And the recoupment is a specific or special inclusion. Okay, because it does relate to capital. It's capital in nature, but it's a special inclusion, right? And you have to include it. Does it make sense?
Yes.
Okay, so some things you have to specifically include even though they fall outside of the gross income definition. Okay, residents and non-residents we spoke about before. The same thing applies here. Okay, if you're a resident, you would have to pay CGT on all your assets anywhere in the world. Right, so if you have property in another country and you're a resident of South Africa, okay, when you sell that foreign property, okay, that foreign property will still attract capital gains tax in South Africa. Okay, South Africa, in terms of government, okay, SARS will collect tax on that sale of foreign property anywhere in the world, okay, because you're a resident. Non-residents, only in South Africa. Right, so if you're an American and you own property in South Africa, if you sell that property will attract CGT. Okay, only property in South Africa if you're a non-resident. Right, so you can have a foreigner owning land or property in South Africa. Okay, that's possible. Right, or any asset. It doesn't even have to be land. It could be a building. It could be machinery. It could be any capital asset. Okay, any connection to an SA, a South African establishment, right? So it might be even business related, right? You might have a foreign company like we spoke about Uber. Okay, but Uber's not a good example because they don't really own the property. Okay, they don't own the vehicles, right? Let's talk about maybe a foreign company like McDonald's. Okay, McDonald's will obviously own property in South Africa, right? And if they sell that property, or if they renovate the property, or if they dispose of it, whatever the case might be, McDonald's would have to pay tax if there is a tax complication, a tax consequence in that transaction, if there is CGT as part of it. Okay, do shares form part of CGT? What do you think?
I have no idea.
Would you
Shares.
consider shares as being a capital asset? It could be.
In accounting, yes.
Okay, yeah, so an investment could be considered an asset. So shares, depending on how long you've held them for, did I put a note here? No. Okay, it's the length of time. Okay, so if you've held shares for longer than 5 years, it will automatically be considered part of CGT capital. Okay, but if you've held shares for 1 month, right, then it'll be seen as revenue. Okay, because then you're buying and selling shares rather than buying and holding shares, which would be seen as an investment. Okay, comes back to what we said earlier. Subjective tests, objective tests. All right, are you buying and selling shares, or are you buying and holding shares as an investment? All right, so that's something to consider as well when looking at CGT, the length of time. Okay, the longer you hold an asset for, the more likely it would be seen as capital rather than revenue. Right, and that's why it's important to understand the consequences of your decisions. Okay, because if you're buying and selling shares frequently, then you are going to be taxed according to revenue, and the tax on that would be much, much, much higher than if it was considered capital gains. Right, CGT, as though even though it's something that was incorporated in 2001 as something additional in terms of tax, it's still better than revenue. Okay, so you'd much rather have something taxed as capital than taxed as revenue, right? Because when you're getting taxed based on CGT, there is a certain amount that will be removed. Okay, so they talk about certain exemptions, okay, capital gains exemptions, and also exclusions. Okay, but that applies mainly to individuals. Okay, so if you're holding property or other, there could be certain exceptions and exclusions, right? But it can also apply to certain types of businesses depending on legislation. Okay, so what's defined as an asset? What makes an asset an asset?
It's not an inflow of funds. Was it an inflow?
Not quite. Not only an inflow of funds. What else? Think about the definition. Accounting definition of an asset.
Oh, I know it, but for some reason I can't remember.
It's a resource that gives rise to future benefit.
Yep.
Remember that?
Yes.
Okay, so
Future
any
benefit
resource will obviously give future benefits. So in the eighth schedule, it's seen as something that's additional, something that's different, something that's not part of the normal income tax act, because income is operations. Okay, operations is day-to-day running of the business. Right, when you're looking at an asset, it kind of falls a little bit outside of the scope. So that's why you have movable and immovable, intangible and tangible. And then you have others as well. Okay, so the definitions are described in the Income Tax Act under the 8th schedule. Okay, it's like in accounting, you use IFRS. IFRS defines an asset as a resource. Okay, in tax, okay, an asset is defined also in terms of resources, but it's very specific because not all things will be considered an asset. Some things will be considered revenue, okay, income, right? So you can hold gold and platinum coins, right? You can also hold currency, right? Would money be considered an asset?
Yes.
No, excluding. Okay, you can't hold money as an asset from a tax perspective, right? So capital gains tax, CGT. CGT will never ever apply to money, currency. Okay, so if you're buying and selling currency, let's say you're a business that you're operating in the USA, okay, and you're obviously operating in South Africa, and there's going to be currency that's going to be exchanged, okay, rands and dollars. But obviously, it's going to be treated as revenue. It'll never ever be considered capital, even if you've held those dollars for, let's say, years. Okay, let's say you've held those dollars for 5 years, 10 years, 20 years. Okay, money falls outside the scope of CGT. Okay, but if you hold gold coins or platinum coins or other intangibles or other tangibles or intangibles or movable and immovable property, okay, all of that is specifically included under CGT, okay, capital gains, under the 8th schedule. Okay, so I'm just giving you a bit of insight in terms of the tax legislation. If you're looking at CGT, we're focusing specifically on the 8th schedule, and we're following rules and regulations outlined in that 8th schedule. Right, so when is a CGT applicable? Well, obviously, when I have a disposal, right, or a deemed disposal. Okay, what's the word deemed referring to?
Supposedly.
Yes, yeah, exactly. Good. Okay, so when you have CGT, you don't even have to sell the asset to trigger an event that is similar to a sale. Okay, a simple example could be something like let's talk about a divorce maybe. Okay, if you're married and you get divorced, obviously assets are split. Okay, and then the splitting of those assets could possibly trigger a disposal event. Okay, or another one could be immigration. Okay, let's say you immigrate to another country, but you keep your investment in South Africa. Okay, even though you've still got those properties in South Africa, because you've immigrated, there could be a deemed disposal. Okay, so SARS will say, well, because you've immigrated, we're going to deem that you've disposed of all your assets. And then that event would trigger a CGT event that you would have to pay tax on, even though you still hold those properties. That's just how it works. Different events can trigger CGT. Either the actual disposal, so selling it, or deemed, in other words, like you've sold it. Okay. There is a difference, though, between individuals and juristic persons. Right, so it's very, very specific. You'd have to look at the legislation to identify what is applicable and what isn't. Okay, as an individual, you do get certain exemptions and exclusions. Okay, so it is obviously better to some degree um, having those exemptions and exclusions as an individual, because ultimately you are going to pay less in terms of tax from a CGT perspective. Okay, versus a company that might have to pay more tax depending on the rules and regulations. Okay, is that all right? Does it make sense?
Yes.
Okay, so this is the very, 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 very important slide. Okay, whenever you have a tax calculation with CGT, you have to use this format. Okay, we're always going to use this format when doing anything CGT related. Okay, so you've got proceeds, you've got base costs. If you subtract base costs from proceeds, you get the capital gain. All right, then you've got to add less, so subtract any exclusions. Okay, and then you've got to add or subtract the adjustments from last year, and that gives you a net capital gain. Okay, the net capital gain will be multiplied by an inclusion rate. Okay, depending on what type of business you are, and then only this bottom bit, only this amount. Okay, this amount is going to be included in the taxable income calculation. Right, so I said here at the bottom, what happens to this? Okay, I'm referring to the red. Okay, so notice everything we're looking at in study unit 7 covers what's in black. Okay, you'll look at different scenarios where you have to work out the proceeds, the base cost, etc., etc. Okay, once you've done all of that, okay, CGT is a separate working or calculation that you would do as a separate calculation, and then only the final answer, only this amount, the one at the bottom, this gets put into the taxable income calculation. Okay, and where do we see that? Let me go back. Here, there's it. Do you see it?
Yes.
Okay, so you're doing a very long, complex working and calculation, right, to get one figure, and only that one figure will be included here. Right, so when you're looking at study unit 7, in different exam questions, okay, you'll see they'll give you lots and lots of information relating to that specific asset, because you're going to have to work out what the actual taxable capital gain is. If it's a taxable capital gain, remember it's only what's been included as part of the working. Is that all right?
Yes.
Okay, so the inclusion rate, all of these adjustments, etc., all of that needs to be worked out first before you get the final answer, and that final answer would be included in the taxable income calculation. Right, so what are the actual inclusion rates or the effective rates? In other words, what do you actually end up paying? Okay, so if I'm looking at CGT, capital gains tax, obviously natural persons, okay, so you and I, juristic persons, companies, okay, CCs, public private, okay. Right, so when you're looking at tax of capital gains, okay, these are the maximum effective tax rates taking those inclusions into consideration. Right, so an individual and a trust, in terms of their maximum effective rate of tax, would be 18%. Companies, 22.4%, and trusts, 36%. Right, that applies in terms of CGT, taxation of capital gains. Right, so obviously from a tax perspective, okay, it would be better to be taxed according to these rates than according to the normal. Okay, because remember, individuals and special trusts can go all the way up to 45% tax. Do you remember that?
Yes.
Companies tax can be as high as 28. Do you remember that?
Yes.
And other trusts up to 45. Remember that?
Yes.
Okay, so you can see that capital gains tax, even if you're looking at the inclusion rates, the tax rates, the effective maximum tax rates, are still lower than the marginal tax rates of companies, trusts, and individuals. Okay, so the reason why I'm showing you this is because you can see that ideally you would want everything to be considered CGT because CGT will be less than normal tax. Got that?
Yes.
Okay. Right, something else to consider if you're looking at an individual, okay, certain events can trigger a disposal. All right, so if you sell something, even if you donate something, right, if there's an exchange, if there's a loss, if there's a death, or if there's immigration, okay, those events will trigger CGT. Okay, it'll trigger a disposal. Right, so if you die and you leave your assets to your kids or your loved ones, okay, your spouse, whoever, okay, that death would trigger CGT. Okay, and obviously you would have to follow the capital gains tax legislation. Right, there are some exclusions. Okay, so as an individual, okay, if you dispose of your primary residence means where you live. Okay, so if you sell your house and your house generates a 2 million rand gain or loss, okay, it'll be excluded. All right, so SARS won't tax that gain or loss, irrespective of what it is. Okay, as long as it's 2 million rand or less.
So is the 2 million like the profit,
Yes, the
or is
gain.
it like the selling price?
No, it's the gain.
Okay.
Okay, so you would have to sell maybe like a 10 million rand house. Okay, you sold it, and the base cost when you bought the house was 5 million. Okay, we'll talk about what base cost is. You don't know what that is yet. Okay, but we'll get there eventually. Okay, base cost would be something like a carrying value almost, kind of, not quite. Okay, so if you work out the capital gain, it might be 5 million. Right, that 5 million, if it's your primary residence, okay, you would minus 2 million and only 3 million will be taxable from a SARS perspective. Does it make sense?
Yes.
Yeah, so it's the 2 million rand gain or loss.
Okay.
Okay, every year there's an annual exclusion of 40,000. Okay, so you can sell things during the year. Right, as long as you don't exceed 40,000, right, you won't get taxed on any of it. Okay, if you exceed 40,000 as a gain, then you will get taxed on it. Small business exclusion of capital gains. Okay, obviously these are small businesses, right? So 1.8 million for individuals, okay? And when a small business with a market value is not exceeding 10 million, okay, is disposed of. All right, so you can see that there is an exclusion for businesses, right? Either an individual owning a business or a small business with a market value not exceeding 10 million. All right, and then if you have death, okay, so in other words, if you die, right, the annual exclusion is bumped up from 40 to 300,000. Right, here's the capital gains tax in terms of the inclusion rates. Okay, individuals have to include 40% of the gain. Other taxpayers have to include 80% of the gain. Right, that's what you have to include, okay, of the gain. So if the gain is, let's say, 10 million, let's say you make a capital gain of 10 million, 40% of that gain will be included as part of the taxable capital gain portion. Does that make sense?
So you don't pay tax on the whole 10 million.
No. Okay. If you're an individual, remember the inclusion rates? Here.
Hmm?
Okay, 40% for individuals, 80% for other.
Okay.
Okay, so if your gain is 10 million, you have to multiply that by 40% or 80%, okay, and then you'll get 4 million or 8 million. Does that make sense?
Yes.
Okay, and then this will be part of your taxable income. Make sense?
Yes.
Okay. All right, there's the note you saw from last week. Okay, I spoke about a recoupment, which is a recovery of previously claimed capital allowances. Okay, a scrapping allowance would be a loss on the disposal from a SARS tax perspective. Okay, so the one would be seen as a profit and the one would be seen as a loss. Okay, just remember that a recoupment is always limited to the previous allowance that you've claimed. Okay, so SARS will never, ever, ever allow you to obviously claim more than what they've provided you with or what they've given you. Okay, and you'll see that in some examples a bit later. All right, here's an important working. Okay, these are all slides looking at each of those lines. Okay, remember the black? Remember this? Remember this?
Yes.
Okay, have a look at the process. Step 1, step 2, step 3, step 4, etc. Okay, so proceeds must be calculated. Base cost must be calculated. Do you see that?
Yes.
Okay, when you're doing those workings are covered here. Right, so to establish the proceeds, okay, to calculate the proceeds, you have to use this formula. Okay, you're going to include the selling price minus any recoupment. Okay, a recoupment is obviously specifically included in income. Okay, so you can't include it twice. Right, so if you have a recoupment, if the recoupment is part of income, a special inclusion, okay, it must be taken out of the proceeds because if you don't, you're double accounting for it. Does that make sense?
Yes.
Okay, so when you're working out the proceeds, you're always going to subtract any recoupment that is applicable in the question. Right, then you've got a working for base costs. Okay, when you work out the base costs, it all depends on timing as well. Okay, so I've just put a note here. It's similar to accounting because you're looking at this historical costs. Right, so in other words, when you bought the asset, how much did you buy the asset for? Okay, any costs associated with the setup or installation will also be included. Okay, important here, any capital allowances or deductible expenditure will not form part of the base costs. Okay, it's excluded. Right, so when establishing what the base cost is, it's important to know whether we are before or after CGT commencement. Okay, when did CGT commence?
2008.
No, 2001. We just spoke about it earlier.
Oh, 2001. Sorry.
Yeah, 1 October 2001. Okay, that was when CGT started. Start of CGT, becoming legislation, law. Okay, so how do we calculate the base cost before or after? If it's after CGT, so in other words, if you bought property in 2005, okay, if you buy property in 2005, which is after the commencement of CGT, your base cost would be your costs minus any allowable deductions. That would be your base costs. Make sense?
What would be an allowable deduction?
Allowable deduction would be something that you would have claimed in the form of capital allowances potentially. So it could be wear and tear.
Okay.
It could be capital allowances. Is that all
Okay.
right?
Yes.
Okay. If it's before CGT commencement, so in other words, if you bought property in 1999, okay, then The base costs, the BC, the base costs, is going to be the valuation value plus allowable cost post CGT commencement. Okay, valuation value would be applicable to 2001. Okay, back in 2001, different people that held property, if you held property back in 2001, okay, before CGT was implemented, okay, government said you can go get an estate agent or someone that can value your property. And from that point onwards, we're going to use that as the valuation date value. Okay, because remember, let's assume you bought property in 1970. That's a long time ago. Okay, that property could still be owned in 2020 2001. Okay, obviously that's 31 years of growth. Do you agree?
Yes.
Okay, so obviously if you bought property in 1970, let's say you bought property in Santon. Okay, obviously the value in 2001 could have jumped dramatically. Okay, maybe you bought the property back in 1970 at 100,000. Okay, and now in 2001 your property is worth 10 million. Right, that's a huge increase in value over a long period of time. Okay, but what is SARS going to say? Well, SARS is going to say, well, this legislation only came in 2001. It would be unfair to tax you on 9.9 million in increased value from 1970. That wouldn't be fair. Okay, so what they said is in 2001, value your property and tell us what your property is worth. So we're not going to use 1970 in terms of cost price. We're going to use 2001's valuation date value. And maybe when you valued your property back then, it was worth maybe 8 million. Okay. All right, and that's what they're going to use as the valuation value. Right, they will also include any allowable costs post CGT commencement dates. Okay, if there are any applicable costs. Make sense?
Yes.
Okay, it is quite easy to identify what's happening in the question because when they test this, they have to be very specific. They have to tell you what is allowable and what isn't. And they have to give you dates and they have to tell you what the asset is worth. Right, so you're never ever going to have to worry about guessing. Okay, they have to give you that information if they are testing this working, this calculation. All right, something else to consider. If I have purchased property before October 2001, okay, this is something I have to consider. Right, there's two, let's call it sub points, what's the word? Sub checks. Okay, checking. Okay, you've got to check these things. Okay, so if I purchased property in 1970 or 1999, whenever, okay, if it was before 2001, right, you have to check if the proceeds, in other words, when you sell that property, if the proceeds are greater than the base costs, then the valuation is the highest of either market value, 20% of the adjusted proceeds less the allowable costs, or a timed apportioned base costs. Right, and it's even more complicated because if it's market value, then you have to consider this. If it's used property, okay, adjusted proceeds are less than the market value, then the valuation value is the adjusted proceeds, less any allowable deductions. If it's the adjusted proceeds greater than market value, then you use the valuation value as the market value. Right, so again, it's a check just to make sure that you're using the right value to determine the CGT. That's all. Okay, so it's quite specific and the rules are quite hectic, but you're just going to use the rules as is. Okay, so when you do questions, you literally copy paste this and then you discuss it. Okay, what is the market value? What is the 20% adjusted proceeds less allowable costs? What is the time apportioned base costs? And then the highest of all of them, the highest of those three, that will be used as part of the working. All right, does that make sense?
Yes.
Okay, so you'll see it in action just now. We'll look at some examples in the study guide. You can see what they actually refer to. Right, and then if it's pre-CGT commencements, in other words, if it's before, and you cannot determine the costs, right, then the valuation value is the highest of the market value and 20% of the adjusted proceeds less allowable costs. All right, so this is pre-CGT commencement. Okay, the base cost can't be determined, so you don't know how much you bought the property for. 1970 is a long time ago. Okay, maybe the transaction details are missing or lost, or you don't have it. It can't be established, right? If it can't be determined, it can't be established. Then SARS is going to use this as a way to calculate the valuation value, right? All of these workings are looking at the valuation. Okay, what is the valuation value going to be? Right, once you've got that, then you need to follow this step. Okay, if you've got an assessed loss or gain from a previous year, okay, is SARS going to take that into consideration in the current year? Yes, they can. But be careful though, sometimes they ring fence certain transactions. Okay, because remember, when you're looking at this calculation, let me go back here. Okay, sometimes if you've got income, let's assume the income is 5 million. Okay, allowances deduction 1 million. Okay, 4 million. Right, and then you've got this capital gain or loss. Right, let's assume it's a loss. Okay, let's say you've bought and sold property and it's a building. Right, and that building leads to a loss of 5 million. Okay, this is going to reduce the taxable income to 0. Do you agree? Because
Yes.
there's no taxable income, because the loss on the sale of the building was negative 5 million. So 4 million minus 5 million gives you negative 1. Okay, you don't put negatives. Okay, negatives would be an assessed loss. Okay, which can be carried forward to another year. But I'm just going to ignore that for now. Right, would you agree that effectively you'd be paying 0 tax in this year? Does that make sense?
Yes.
Okay, so SARS might say, well, this asset that you've sold, okay, this expensive machine or this property or this building or this whatever, they might say, well, you cannot apply that here, you have to ring fence it. Okay, in other words, if you're ring fencing it, you cannot use that actual gain or loss. Right, it's carried forward from one year to another. Okay, and that's just unfortunate, but that's just how it works. Right, sometimes they ring fence certain amounts to avoid that affecting the current year's taxable income calculation. Okay, because remember, SARS wants to collect. They don't want to end up with a situation where businesses have loss after loss after loss and they're not collecting any taxes. Does that make sense?
Yes.
Okay. Something else to consider is that you do have to aggregate all the gains and losses. Okay, aggregate means to add up. Do you agree?
Yes.
And the total is included in the taxable income calculation. Right, here's a really great summary. I can't do better than this. Okay, so I've just literally taken it from the textbook. This is the reference. Look at the study guide. Okay, proceeds. How do you work out proceeds? Well, the first thing that you need to consider is minus any recoupment, because a recoupment is seen as a special inclusion. Okay, so you get rid of it. Okay, then you need to determine the base cost. This base cost will be calculated either pre-CGT or post-CGT. Okay, if it's post-CGT, it's after 1st October 2001. If it's before CGT, it's before 1st October 2001. Right, if it's before, then you've got to work out the valuation date value. Okay, then you've got 3 options. You can either use market value, time apportioned base costs, or the 20% rule. Okay, and then you'll either apply that depending on what you've got in the question with any cost after, okay, the valuation date. Okay, if it's after, then it's easy, then it's simple. Okay, it's just the cost that you incurred after you bought the asset. So if I bought the asset in 2005, I would obviously have costs after deducting any capital allowances. Okay, that would form part of my base cost. Okay, but yeah, you'll see workings when we go through examples and we do past papers and the assignment. Okay, are we okay?
Yes.
Great. All right, and then the last slide here is just taking it a step further where we're looking at the gains or losses. Okay, once you've got the base costs and the proceeds, obviously the difference is going to be your capital gain. Okay, proceeds minus base costs will give you the gain or the loss. All right, you've got to aggregate all the gains and losses. Once you've aggregated all the gains and losses, then you will either deduct any assessed capital losses from last year, okay, or you'll multiply it by the inclusion rate to get the taxable capital gain. Okay, where does the taxable capital gain go? Goes to the taxable income calculation. Do you agree?
Yes.
Okay, and that's exactly what you're doing here. Right, and that's pretty much it in terms of content. All right, now you've just got to practice and you've got to look at different scenarios where you have capital assets that are being disposed of. Okay, makes sense. Any questions about the theory?
No, not yet.
Great, so let's have a look at practical examples so I can show you how some of this works. If you go to your textbook, your study guide actually, let's quickly go to chapter 7 here. Okay, learning unit 7. Right, in chapter 7, they're obviously going to cover the theory, right, and then they're going to give you some examples, say some working, some calculations. Right, so that's what we're going to be looking at, okay, to explain how CGT is applied in different scenarios. Okay, so I'm going to be looking at that. Maybe before we start with this bit, can we... Okay, so learning unit 7, let's see what we've got here in the textbook. Okay, so the textbook always shows you this working, which is very good. You can see that's the taxable income calculation. Do you see it?
Yes.
Okay, and you can obviously see taxable capital gain is highlighted there because we're going to be looking at specific legislation that affects a business, okay, in terms of the 8th schedule, to calculate or to work out what is included in the taxable income calculation. Right, to get the taxable gain, you need to do that work that we saw earlier. Right, this one. There. Okay, that's what you copy paste, and that's what you're going to be using in every question. Okay, any question that requires a working regarding taxable capital gain will need these lines. Okay, you'll need proceeds, base costs, etc., etc. Okay. All right, they talked about the introduction of CGT. That's fine. That's good. Okay, then they've told you to have a look at those learning units or completing these the learning unit in those weeks. Okay, so 3 weeks for this subject or topic. Okay, the learning outcomes are the same as what we saw earlier. Chapter 6 is the reference, and then they're asking you to look at those pages in the textbook. Okay, this is background. We spoke about this earlier. When did CGT come about? Why was it brought into use? Let's see what else. Identify whether CGT is applicable. Okay, obviously you have to work out whether it's not taxable. Yeah, well, taxable in terms of revenue or taxable in terms of capital. Okay, notice several transactions can be deemed a disposal. Do you see that?
Yes.
Okay, so you don't have to always sell things to give rise to CGT. Sometimes an event that takes place will give rise to CGT.
Could you give me an example?
Immigration or death. Okay, we saw a few examples earlier. or divorce.
Oh,
That
okay.
would be a deemed disposal. Okay, because think about it. Let's assume husband and wife divorce. Okay, the husband's not going to sell the wife an asset. Does that make sense?
Yes.
He might be giving it to her, or let's say husband and wife have several properties. Okay, they live in the house, obviously husband and wife, and then they've got vacation homes in different provinces. Right? Obviously, if they're going to sell everything or split everything, or maybe they don't. Maybe they say, okay, we've got two vacation houses. There's two properties in a specific province. You have one, I'll have one, and that's how we'll split the assets. Does that make sense?
Yes.
Okay, so that could be seen as like a deemed disposal. Okay, but when it's a divorce, it's a bit different because you have something called a rollover, where one spouse can take over an asset without CGT being applied. Okay, but again, it's very, 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 very specific, right? So I'm just using it as an example of a deemed disposal. Okay, or immigration. Okay, you decide to move, pack up, and leave, but you keep your assets. So you keep your property in South Africa. Obviously, your property you'll rent out and you'll derive income, but you're no longer going to stay in this country and you're going to go live and work in another country. All right, then they would say, well, okay, you've immigrated. It's a deemed disposal. We're going to assume that you've sold all your assets and you'll pay CGT the day that you immigrate. Does it make sense?
Yes.
Yeah, but you keep all your assets, they're still yours. But the moment that that happens, that event triggers something. It triggers an event, it triggers a deemed disposal. And that's exactly what you're looking at here. Got that?
Yes.
Okay. Right. What else do we have here? Let's see. Okay, let's just talk about the time of the disposal. Obviously, it must be during the year of assessment. How long is a year of assessment from a taxpayer's point of view?
A year.
Yes, 12 months. Okay, so every 12 months, you'll be looking at disposals that took place during those 12 months. Okay, here's the basic framework for CGT. They've given you proceeds minus base cost, gives you the capital gain or loss. Yeah, that's fine. And then there's that framework. Okay, it's the same as what you've got in your notes. Okay, it's the same except here they've included 80%. Okay, why 80%? Because that's for companies.
Okay. And
Okay.
40% for individuals.
Yeah, 40% for individuals and I think it was special trusts. Let's just go back and check. Yeah, 40% for individual special trusts and policy holder funds. Okay, other taxpayers, so all other 80%. All right, so you've got that framework. It's the same as what you've got in the notes. We're going to be using it. Okay, yeah, natural persons can deduct an annual exclusion. See, they spoke about that annual exclusion. But it only applies to natural people, natural persons. Okay, there's nothing else there. Okay, then proceeds there. There's the working for proceeds. Selling price minus recoupment. We're going to need that calculation. All right, this is quite good because they're showing you the tax value. All right, so remember, tax value is the same as carrying value. In accounting, how do you work out your carrying value?
Cost minus accumulated depreciation.
Good. Okay, when you're looking at tax, you don't have accumulated depreciation. You have things called capital allowances. It could be wear and tear, it could be capital gains, not gains, capital allowances in terms of section, what is it, section 12. Okay, we looked at those last week, right, depending on what type of asset you've got. Right, so when looking at tax value is the costs less the allowances. Do you see that?
Yes.
Okay, here's quite a nice example. Selling price at the date of disposal. Okay, so have a look. I'm going to be selling something at 120. Okay, this asset costs 100. Do you see that?
Yes.
Okay, so this is before and this is now. Okay, so before I bought the asset at 100, here I'm going to sell the asset at 120. Selling price. Okay, transfer duty paid on the purchase. Okay, when I purchase the asset, do you agree if there's transfer duty, that transfer duty is paid on the actual asset value or the price of the asset? Do you agree?
Yes.
Okay, so that transfer duty is paid on the actual purchase. Right, all allowances claimed in previous years was 70. Okay, so if I'm looking at the costs, okay, the allowances was 70 over that time frame. What would the tax value be? Costs less allowances, which is 30. Happy with that?
Why don't you use transfers?
The transfer duty
Like
is a tax. You
to
can't.
the
It's a tax, not a cost. Transfer
okay.
duty is a tax. It's just a different type of tax. Remember earlier? Remember when we started this course?
Yes.
You had a list of different types of taxes,
Yes.
and we had like value-added tax, estate duty, import-export, all of that.
Yes.
Okay, what is transfer duty? Is a transfer duty a cost of purchase or a tax on the purchase?
Tax on the purchase.
It's a tax on the purchase. So you're not going to include tax as part of this working.
Okay, I get it.
Okay, if it was VAT, you also wouldn't include VAT, right?
Yes.
Okay, what happens if it was delivery costs?
You'd add it.
Yes. Okay, because that's applicable to the asset. Does that make sense?
Yes.
Well, when I say applicable to the asset, it's a cost that is an inevitable concomitant to the actual asset that's being purchased. Transfer duty is a separate tax that's paid separately when an asset is purchased. It's separate. It's not linked. Well, yeah, it's a bit of a. Uh, I don't want to use the word linked because it is kind of linked, but not in terms of an additional cost. It's more because of the law, the legislation. Okay, transfer duty is already a tax, basically.
Okay.
Okay. All right. So when we spoke about tax value, we said tax value is what? Cost minus allowances, which is 30. Do you see that?
Yes.
Okay. So now, do you agree? If I'm looking at the selling price is 120. 120 minus 30 gives you 90. Do you see that?
Yes.
That's the profit, right? Profit on sale. Do you agree?
Yes.
Okay, but look at this 90. This 90, a portion of the 90 is taxable allowances. Why is it not highlighting? Let's try that again. Here. Ooh, it highlighted too much. Okay. I only wanted to highlight the 70. Okay. Do you see that if I'm looking at this 70 is capital allowances that were granted by the taxman to the taxpayer over the life of the asset. Does that make sense?
Yes.
Okay, so this 70 is going to be treated as a recoupment. Okay, recoupment means to take back those allowances that they gave you. And then the additional 20 is the capital gain. Do you see that? 20 Rand is the capital gain. But the capital gain is worked out with the adjusted proceeds. So have a look at this. You bought an asset for 100. This is the base cost. Do you agree?
Yes.
Okay, you obviously used the asset. The asset now has a tax value of 30. Do you agree?
Yes.
You've sold the asset at 120. Do you agree?
Yes.
120 exceeds the base cost. This is the capital gain, which is 20. This is a recoupment of the taxable allowances that you received in the past. Does that make sense?
Yes.
Okay, so the base cost is the important bit because anything above the base cost is the taxable gain. That's why it's important to know how much allowances were taken out during the life of the asset. That's why you've got to account for it. Does it make sense?
Yes.
Okay, you'll see it. It'll work out the same. Okay, if you use the formulas, okay, what does the formula say when working out proceeds? The formula says adjusted proceeds is the selling price minus the recoupment. Do we know what the recoupment is now?
Yes.
The recoupment is 70. So I'm going to take out 70. So what's 120 minus 70? 50. Do you see what they've done there? That's the adjusted
Yes.
proceeds.
Okay.
Okay. And then if you work out the capital gain, it'll be 20. Did they show that? No, they didn't. They should have. Okay. All right, let's go back. Okay, obviously the base cost we know was
100.
no. Not sorry. I'm using base cost. The tax value. Tax value was 30. Do you agree?
Yes.
Okay. All right. So the difference is 20. Okay. Where's the There's the adjusted proceeds. Okay, 50. If you go to the textbook, you can even look at this bit. Let me show you this. There. Base costs. Any capital allowance or deductible expenditure will not form part of the base costs. Do you see that? So how many capital allowances
Yes.
did we get? 70. Do you agree?
Yes.
So the base cost is 100 minus 70, which is 30. Do you agree?
Yes.
Okay, there. Right, so you would show 100 minus 70 equals 30 as your base costs. Make sense?
Yes.
Okay, so the adjusted proceeds. The proceeds would have been 120 minus 70. The base cost would have been 100 minus 70. This would have been 50 minus 30. So the gain would be 20. Do you see that?
Yes.
Okay. All right, that's how you do the working. And then obviously take all the other things into consideration. Maybe use the inclusion rate times 80% gives you 16. So 16 will be included as the taxable capital gain in the taxable income calculation. Does that make sense?
Yes.
Okay, so this example is only showing you this bit at the top, not anything at the bottom. Okay. Okay, here's a list of those costs, see, including the base costs. It is obvious that the acquisition cost of an asset will form part of the base cost, but several other costs such as improvements to property, agents, commission, valuation costs, and so on are also part of the base costs. Okay, see, these are costs associated with the actual purchase. Does that make sense?
Yes.
Okay, excluded from the base cost. Yeah, this is important. Capital allowances must be deducted from the base cost of the asset. There's the notes. Okay, here's another example. Have a look at this one. Flowers Limited purchase office building, 12 September, and subsequently sold it on the 30th of November for 500,000. That's the selling price. This is obviously post 2001. Does that make sense?
Yes.
Okay, purchase price was 895 cost price. That was on 2006. So 2006. Okay, in terms of transfer duty and legal costs relating to the purchase of the assets, that was 52,000. Okay, valuation costs were 8. Legal and contract. Okay, so this was transfer duty and legal costs. Okay, so I see they've added it here in this one. Okay, but they didn't add it in this one. Okay, because this was transfer duty paid on the purchase. That was only the transfer duty paid on the purchase. They haven't split it out. They haven't included it. Here, this is looking at base cost for CGT. Right, so this is transfer duty and legal costs relating to the purchase of assets. Right, I would include the legal costs. This, no. Okay, so 52 adding because of the legal costs. Valuation costs, add that. That's correct. That's correct. Legal and contractual costs relating to the sale. That's correct. What else do we have here? Interest paid on the financing? No. That's not included. Repairs and maintenance? No. That's not included. Okay. All right, so what do we have here? 960,000 as the base costs.
Could you not put repairs under expenses?
Yes, repairs and maintenance would be a Section 11A deduction. General deduction formula.
So that would be under income.
Yes, exactly.
Okay.
Interest would also, actually, it would be, because interest paid on the loan of building, interest would be part of the general deduction.
Okay.
Okay, what else do we have here? Okay, there's the note about what's included and what's excluded. I see they've mentioned it again. I think we need to correct Eunice's working here then. Transfer duty paid on the purchase. What happened here? Okay, whose purchase was this? Maybe this is the case. This purchase is by the buyer, not the seller. Because this asset was disposed of. Do you see that?
Yes.
So when I sold the asset, this is the transfer duty paid on the sale, not the purchase. I think the wording is a bit confusing. Do you see that?
Yes.
Okay, when you buy an asset, then you can include the transfer duty and legal costs because it's the purchase. This is buying the asset. Do you see that?
Yes.
Yeah, so just read the question carefully because this does seem a bit confusing because here they said purchase, but this should have been sale actually. Because the buyer purchased the asset, the buyer pays the transfer duty. Do you agree?
Yes.
Okay, so just be careful with that. It looks a bit confusing because you've got purchase here and then you've got this here. Okay, this is when you buy the asset. Here you're the buyer. Here you're the seller. Do you agree?
Yes.
Okay, if I'm the seller, transfer duty doesn't apply to me. Does that make sense?
Yes.
If I'm the buyer, it does. Okay, so it applies here, it doesn't apply there. Okay, I think that makes more sense now because I see it there as well. Okay, so I just wanted to go back and check that because it did look a bit strange. Okay, all right, so those are all things you can include. Those are things that you exclude. Okay, here they're giving you an example. Assets acquired after 1st October 2001. Okay, obviously if it's after, okay, you work out the base cost based on any allowances that were claimed previously. Okay, very straightforward. Right, cost minus anything that's claimed, basically. What else? Okay, here's an example. Okay, you've got rings and things. They manufacture jewelry. Year of assessment 31st March. They manufacture a machine and the company was destroyed in a fire. Okay, the machine was originally purchased second hand. All right, so that was 500,000. 500,000 was the purchase price of the asset. Do you agree?
Yes.
Okay, so let's think about this. If I'm buying the asset and the asset costs 500,000, the 500,000 is representing what? The cost price. Do you agree? That's the cost price when I bought the asset. Make sense?
Yes.
Okay, and it was brought into use on the same date. Okay, the capital allowances claimed in respect of the destroyed machine was 200,000. Okay, so they're telling me that over the life of the asset, I used the asset, and the tax value would be the difference between base cost and the capital allowances. Okay, so how many capital allowances do I have here? 200,000. So my tax value
Yes.
would be 300,000.
300.
Okay, the machine is destroyed. Okay, and it's sold to a scrap dealer for 15. Okay, so obviously 15 is the selling price, so it's below. Selling price is only 15. That's way below the tax value. So there's going to be a scrapping allowance here. Do you see that?
Yes.
Okay, let's carry on reading. What else do we have here? Okay, Rings and Things paid advertising costs of 1,000 to advertise the machine for sale. An indemnity payment was received. Ooh. Okay. All right, that means your proceeds weren't 15. It was 15 plus 600. Do you see that?
Yes.
Okay, so this I need to erase now because now we've got more information. Okay, so now I'm not below, I'm above. Okay, so now no more scrapping allowance. There's no loss here. There's a profit. Okay, so now we know more information. Now I can put that in. Okay, so now I've got 615 here. Okay, so base cost is 500. Okay, capital allowances was 200, but there is going to be a recoupment. The recoupment will be limited to the capital allowances. Do you agree?
Yes.
Okay, so the recoupment will be 200. Make sense?
Yes.
And my capital gain will be the difference between what I have in terms of my selling price, okay, which will be, let's think, this would be the difference. How much is the difference? Carrying value is 300. So 615 minus 300 is how much? No, minus 200 is 415.
Or
Because I need to minus the recoupment. Okay, so 415 minus the 200 Rand recoupment. And then I've got the base cost. The base cost would be 500 less the recoupment. Not recoupment, less the capital allowances, which is the tax value. There's the tax value, which is 300. Do you see that?
yes.
Okay, there were advertising costs. Let me go back to this page. I just want to see, what do I do with the advertising costs? Okay, base costs, all other costs associated with setup or installation. Okay, so allowable cost post the commencement date. This was after 2001, so I get to add it. So I can add those costs of 1,000. Do you see that?
But why? Wouldn't that also go under expenses?
No, but it's
The
part of the
cost.
sale. You're advertising the sale. It's not operations, it's capital in nature. You're not
Okay.
advertising your goods that you're selling in the shop. You're advertising a vehicle that's going to be sold.
Okay.
Do you see the difference?
Yes.
Okay, it's not, there's no enduring benefits. This is specific to the assets. Okay, so plus 1. All right, so what's 3 plus 1? 301. 301,000, and then we've got the 415. Ooh, what happened to it? Here's it. Okay, so the capital gain would be the difference between those two. Grab my calculator. What is it? 415 minus 301 gives me 114. 114,000 is the difference. Do you see that?
Yes.
Okay. All right. So tax value. What's our tax value here? Tax value here was 300,000. Okay. What is the recoupment? We spoke about the recoupment. The recoupment is always limited to the capital allowances, so 200. Do you agree?
Yes.
Okay. The adjusted proceeds we worked out was 415. Okay, base cost minus recoupment. The base cost, we worked that out. The base cost was the 300,000 minus the recoupment.
Was our base cost not
No,
500,000?
500,000. Sorry.
Okay.
Yeah,
Yeah.
I'm reading it wrong. 500 minus the recoupment, which was 200, plus
But why would
plus
you
the 1,000. Do you see that? Okay, and then the capital gain was that. Is the answer here? Where's the answer? Assets acquired before. Oh, I think these are activities. Okay. Okay, so these came during the question instead of afterwards. Normally they're afterwards. Self-assessment questions, where are they? Oh, there are more. Okay, looks like there's a lot here actually. Wow, yeah, there's a lot here. Okay, and then that's the end of the module. Okay, there. Solutions. All right, so what is this? Number 7.1. 7.1, there's it. Let's see if it's the same. Okay, yeah, tax value was the same. The recoupment is actually, okay, their working is a bit better because they've shown all of it. So they've shown proceeds, okay, less tax value gives you recoupment, and then they said limited to 200. Okay, obviously this is better because they're telling you all the steps. All right, they're writing it out. This is how I would do it in an exam. Okay, write everything down so they can see it. Right, so show the 315 but limited to 200,000. That's good. Okay, adjusted proceeds, that's good. Base cost 500 plus 1 minus 200 gives you that. Yeah, that's good. Capital gain, proceeds minus base costs. Yeah, we had the same thing, 114. I still have it on my calculator actually. Okay, and then the capital gain is obviously an inclusion rate of 80%. Okay, that we didn't do. Okay, that's the last bit. Times it by 80%. All right, does that make sense?
Yes.
Okay, all right, and that's how you do tax, capital gains tax. It just requires lots and lots and lots and lots and lots of rules. Okay, you've got to look at each and every one of those rules, unfortunately. That's the only way to do it. Okay, let's look at one more. Let's see, there's another long one. Okay, this is assets acquired before. Right, if it's before October 2001, then we've got to use that whole long method, this one. Let me go show you. Here, there, before. Okay, before commencement. All right, valuation date and allowable costs. Okay, then we need to check. If it's purchased before, we need to check these two things. We need to check the valuation value and we need to check the valuation value. Right, if it's pre-CGT or after. Okay, so okay, there's the formula. They gave you the formula. Okay, there's the note about the three different values. See, market value, 20% rule, time apportioned base costs. Okay, the final step is to work out the valuation date value. That's obviously what we're looking for. Okay, that's fine. Okay, this is a summary. Okay, they've taken this from paragraph 26. That would have come from the Income Tax Act. Okay, the 8th schedule. All right, proceeds greater than base costs. The valuation date is the highest of. Okay, you've got that in your notes. Okay, all of this is in your notes. That's in your notes. That's in your notes. And then there's the check as well for the market value. This applies to the market value. Okay. All right, so yeah, that's just the note that you've got. Okay, here's an example. Let's look at this one. Okay, all right. GoGo Limited purchased an office building. Obviously, 1984 is before. Do you see that?
Yes.
Okay, so we're sitting pre-CGT. Okay. After, no. Before, yes. Okay, so valuation value is what we're determining. That's the hard part. Okay, valuation value needs to be calculated and then add any allowable cost post CGT. Right, so if it's purchased before, I need to apply all of these steps. Okay, so what do I have here? Okay, there, cost price was 1.2 million. Okay, that value. No capital allowances were claimed in respect of this building. Transfer duty and transfer costs amounted to 133,500. Okay, can you see that?
Yes.
Right. So what are those costs referring to?
Transfer
When?
when they bought it. Oh,
Exactly.
yeah.
When you purchased the asset, which was pre 2001. Do you agree?
Yes.
Okay. During November 2006, is this pre or post?
Post.
Good. Okay, this is post, and these were improvements made to the building. This was 832,000.
32.
Okay, the company sold the building in 2020 for 12.5 million. Okay, that's obviously the proceeds. Do you see that?
Yes.
Okay, they've given you a timed apportioned base cost given, and they've told you that there were agents' commission of 67,500. That's obviously when the building was sold. Do you agree?
Yes.
Okay. They said required. Calculate the capital gain or loss. Okay. Um, realize selling the building. Okay. If the market value. There we go. We needed that. Okay. There. Market value is either 12 million or market value is 14 million. Right. So 12 million is market value. Okay. For number A. Do you agree?
Yes.
Okay. So if proceeds are greater than the base costs. Okay. Are the proceeds greater than the base cost? Yes, we know that. Market value. If this is used, the adjusted proceeds is less than the market value. Then the valuation value is the adjusted proceeds less the liable deductions. Okay, we need to check that. Adjusted proceeds greater than market value, then valuation value is the market value. Okay, so we need to identify which is which. Okay, what are my adjusted proceeds? Is there recoupment here? Let's go back and check. Okay, so what was my selling price?
Just before we go on, when they say time apportionment base cost, what does that mean?
It means basically based on time. So, in other words, from 1984 all the way through to 2020. Okay, the actual value of the building has grown by or grown to 4.9 million from 2.2 million. It's almost like inflation, kind of, if that makes sense. Values change over time,
Yes.
and then you can use a inflation rate to take amounts to the current point in time. Does that make sense?
Yes.
So the time apportioned base cost is just that. It's a way to provide for X number of years from when you had first bought the asset to now.
Okay.
But remember, that's not realistic, because if you bought property in Sandton, the timed apportioned base cost is not a realistic value of its actual value or the market value.
Okay. So
That could be
it's
something
basically
that's
the
based on
inflation.
inflation.
Okay.
Is that all right?
Yes.
Okay, you're never going to have to work that out. It'll always be given to you.
Okay.
Okay, that's a bit beyond the scope of this subject. Okay, all right. It is possible to calculate, but there is a formula that you have to follow for it. Okay, so what is my market value? Okay, first of all, what is my adjusted proceeds? Did I have any capital allowances?
No.
So can there be a recoupment? No. Does that make sense?
No. Yes.
So what would your adjusted proceeds be? Selling price minus 0. Do you agree?
So in the first thing, it would be 12.5 million.
Yes. Yeah, that's right. Because there's no recoupment. Make sense?
Yes.
Okay, perfect. Okay, this is before commencement date. So valuation value plus allowable costs post. Okay, we need to check this. Right, so in A, we said that the market value was 12 mil. Do you agree?
Yes.
Okay, the proceeds is how much? 12.5. Do you agree?
Yes.
Okay, so if you've got 12.5 as the proceeds, what is the base cost going to be? The base cost is going to be, let's go back.
Just a quick one.
Yeah.
Would we not add the 133.5?
Yes, you would. That's because it's before. It's before.
Okay.
It's before. That was the cost that was acquired when you acquired the asset.
So we don't use it now.
No, you do, but that's before. Because what is the cost? What is the cost of the asset when you bought it?
1.2.
Yes, 1.2, and then you're adding the
100.
133,500. Does it make sense?
Yes. Okay.
Okay, so what is that going to give you as a base cost?
Right. That will give you 1.368.
Okay, all right. So you've got that bit. Do you agree?
Yes.
All right, that's what you've got. Do you agree?
Yes.
Okay, so now that you have that figure, did we have any costs after CGT?
Yes.
What did we have?
We improved the house.
Did we? Hey, yeah, we did. Yeah, the 832. So you'll
32.
add that. So add that to the amount that you've got in your calculator, plus this commission.
The 67,500.
Yes, and what does that give you?
2,268,000.
Okay, so
So
that's this
2.2.
base cost. That now we've looked at that step. Do you agree?
Yes.
Okay, so now that you've got that step, now we need to do the last step. Okay, so okay, I'm going to type in here. Let me just save this first. Okay, let me type here. Proceeds were what? 12.5 million. Do you agree?
Yes.
Base cost is what you just worked out. Give it to me. What did you get?
2,268. And then 3 zeros.
Oh, okay, yeah, that's fine. Okay, so are the proceeds greater than the base cost?
Yes.
So the valuation value is the highest of market value. What is the market value?
12.
12 million. What was the 20%? What is the adjusted proceeds less allowable costs? 20% of it. So the adjusted proceeds we worked it out as, what is it? 12.5 million, right? It was 12.5 because there was no recoupment, right?
Yes.
Okay, minus allowable costs. Allowable costs. What were our allowable costs?
It's not zero.
No, the allowable cost was what we had improved the building. That's what we allowed.
Oh,
Because remember, this was
8.
post CGT. No, well, it was before, but this is post. So the allowable cost is what I'm adding.
So it's 832.
Yes, and the other amount. What was the other amount?
Are you talking about the commission?
Yeah, there were two amounts.
67.5.
Ah, okay, there we go. Okay, on the calculator, let's work that out. 12.5 minus 820. Sorry, 832 minus 67.5 gives you 11.6500. 20% of this. 20% of 11,600,500 is times 20%. I get 232,011,100. I get that. Do
Yes.
you get that as well? Hey?
Yes.
Okay. What is the time apportioned base cost?
It was 4,924,475.
Was that it?
4924475. Yes.
Okay, so which is the highest amount?
12.5.
No. Market value is the highest amount.
Oh, okay.
12 is bigger than 2.3, which is bigger than 4.9, right?
Yes.
So what is my valuation value? 12 million.
Okay.
Okay. So now if I go back here, I'm going to say 12 million plus those post CGT commencement date costs. Do you agree?
Yes.
So now I can put that in here. 12 mil plus what was the amount? It was, what is it? 832, and what is the other one?
67,500.
Okay. So then that'll be what? 12. Okay, then there's an 8. 6 plus 3 is 9. Ooh. Is that right? No. No, it is right. Yeah. 6 plus 3 is 9. And then 7 plus 2 is 9. And then 500. That should be it. Okay, that's the base cost. Do you see that?
Yes.
Okay, so there's my base costs. All right, so now that I have the base cost, this 12,899 is going to go here. Proceeds was 12 and a half, right?
Yes.
Okay, so what's the difference?
499. 500. Negative. It's a loss.
12.5 minus 12,899.5. I'm
So
getting,
it's
yeah, I'm getting
minus.
399,500. That's what I'm getting as a negative.
Yes.
So this is a capital loss. Do you agree?
Yes.
Okay, if it's a capital loss, unless it's ring fenced, you will still times it by the inclusion rate. Do you agree?
Yes.
Okay, so 80% of this will be included as part of the taxable capital loss that will be here. Does that make sense?
Yes.
Okay. Is that all right? Did you get that?
Yes.
Okay. All right. So we've answered number 1. Let's just check all of this. Answers. Oh, we need to scroll further down again, eh? This is 3. Okay, this is 7.3. Okay, there's more questions here. Yeah, these other ones I'm going to ask you to have a look at. Okay, because now we've looked at the 2 examples. This one was a good one because it showed you the before. The before is always more difficult because you have to do these extra checks. Okay, let me just find it first, then we can check it. Where are we? 6.1, 7.1. Okay, here. No, this is 7.1. Okay, yeah, 7.2. Okay, there's the 12 and a half. That was fine. There was no recoupment. That's fine. I agree with this. Okay, what did they work out here? Okay, here they calculated the base costs. Okay, yeah. Okay, their workings are a bit different because they've used the table. It's fine though. Okay, so the first thing that we worked out was that because we added the before. That was fine. Then we said this was the after, which is allowable, which we have to add. Do you agree?
Yes.
So we got the same figure at the end of the day. Okay, that's the same answer. Okay, then we did the check. There's the checking. Market value was right. That one, what was our figure? What page is this? This is page 65. Hold on, where did I do the working?
You did the
Oh,
working on your notes.
ah, I wonder. No wonder. Okay, where is it? Where is it? Where is it? Here. Yeah. Okay, there's the proceeds. There's the base costs. Where was that other working? Yes, there we go. Yeah, that looks the same. Page 65. Was it the same? Yeah, it was the same. And then there's the one that was given. Yeah, that's fine. See, valuation date value was the 12 million. That was fine. And then we added the, okay, they just showed it as one amount, added. Cost after, that's fine. The capital loss, that's fine. Yeah, it all looks right. It's all good, yeah. Okay, their workings are quite good. Better than before. They've given more steps here, which is better. Okay, and then, okay, they stopped there. Okay, then we looked at the inclusion, times it by 80%, taxable capital gain, well, 80% of that. Capital loss, actually. Make sense?
Yes.
Okay. Are you right with that? Can you see what we did?
Yes, it's just a lot of rules, I think.
Yeah, unfortunately, that's tax for you, hey? Tax is like this. Tax is very much rule-based, hey? So it's just rules, 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 rules. That's why I've tried to use these notes because these are like literally I'm going to use these notes when we do past papers. Okay, I don't want to save the stuff that I wrote here. So I'm going to say no. Okay, but yeah, when we do past papers, I'm literally going to copy paste stuff from my notes and then we just do it that way. But yeah, their workings here are actually really good. As I said, they're much better than before because they show more workings. In the past, they used to just give answers. They didn't show as much working, so they've definitely improved the solutions, which is a good sign. Yeah, because they've even broken it down here and stuff, and they've shown you the calculation. So yeah, really good. Yeah, so much, much, much better examples. Okay, so are you happy with that? Besides it being
Yeah.
very rule based and lots of considerations, are you okay with the approach?
Yes.
Okay, as long as you know what you're looking at, the dates are so important. That's why you've got to look at the dates so you know what to apply. What if it's before? Before is always going to be difficult.
Okay.
Okay, because it's before. You've got to do these workings. If it's post, it's easy. Then you just do this bit. Okay. All right. So you've looked at one which was after, and then you've looked at one which was before. Let's go back to the textbook. Okay, so I've done 1 and 2 with you. There's obviously a few more here that you can have a look at. Have a look at 3. Okay, if I look at 3, what does it say here? On the 1st of April 2019, they purchased. Okay, this is post. That one's an easy one. Do you see that?
Okay.
Okay, this is
Yes.
post. So this is similar to 7.1. Do you agree?
Yes.
Okay, because it's after. You bought it after 2001, which is post the commencement of CGT. Does that make sense?
Yes.
Okay, so try that one. Look at that one. It'll be similar to 7.1. It might be a bit different because I see they've asked you. Oh no, they've asked the same thing actually. Yeah, except this bit here at the bottom. I think this is a bit different because it's a capital loss. Okay, so the capital loss is just something that carries forward from the previous year. And then you've got to use. Okay, I closed my PowerPoint. Remember my PowerPoint? When you work out the taxable capital gain, you've got proceeds, then you've got base cost, and then you've got all those different lines. One of the lines talks about the assessed losses from last year. Then this is going to go into that table there. Okay, it looks like this table here, the one that we saw earlier. There, this one. Okay, there. Less assessed capital loss from the previous year. That's all you're going to add there. That's the only difference what that one looks like it. Does that make sense?
Yes.
Okay, yeah. So try that one. That one's an easy one. You shouldn't struggle with post CGT. It's the before that's tricky. So let me go back to 7.3. Okay, 7.3 I finished. Okay, it's fine. 7.4, what is this one? Okay, office building sold January 2021. The building had been acquired June. Okay, is this before or after?
Before.
Yes. Okay, now you're going to do all of those workings the same as we did just now. You're going to have to work out your base cost, and then you're going to have to work out the greatest of the market value times the portion cost into the 20%. Does that make sense?
Yes.
Okay, this one, 2021, Oh, this is also post. This is post CGT. This one's an easy one. Okay, so the only one that you might struggle with is this one. Okay, because this is before. This one we can discuss if you do struggle, but have a look at it, see if you can do it, see how you go, because they've given you all the values there. There's the time to portion based costs. There's the market value of the building. Do you see that?
Yes.
Okay. All right. So try that one, and then let's see. Okay, there's another one. Shit, there's a lot here. Oh, there's even another one. Wow, there's a lot. 7.5. Let's look at this one. This is 31st March. This is July 20, 2001. Yeah, this is before again. Do you see that?
Yes.
Okay, so you're going to have to do it again. Same working as before. They'll give you the valuation value. They'll give the time proportion base costs. They have to because you've got to work it out. Here there are capital allowances. So if there are capital allowances in this question, you'll have a recoupment. If the selling price is greater than. Sold at a market value. The market value is 894,000. There were capital allowances. This could possibly be a recoupment one because the purchase price was only 80 and the valuation is quite low. Yeah, so I do think there is a profit here. And also looking at the question, I know there's a profit now. Okay, they said calculate the recoupment. There is a profit on sale. Does that make sense?
Yes.
Okay, so this one's before again, and then you've got a calculation for recoupment. And then the last one, yeah, that's the last one. Okay, 7.6. 31st March 2021, 2007. This is post. That's an easy one. Post CGT. That's good. That's easy. This is also post CGT. This is also good. Yeah, this is easy. Yeah, this is an easy one. Part A, easy. That you shouldn't struggle with too much. This one is 2020. This is September. September is before October. This is another before. Do you see that?
Yes.
Okay, yeah. So you've got a mix. You've got before, after, before, after, before, after. But you've got a few other ones to look at as well. Yeah, we can definitely go through more of these next week. Next week, we're going to do the assignment. So I want to open the assignment now just to see what it looks like. And let's just see if you can complete any of these questions. You should be able to, but obviously just try. And try using the notes if you can. Okay, because it's an open book assessment, you can use your notes as much as you want to, but just get better at using it. I would just use the slides because that's a little bit more summarized, but either or works. Let's find assignment 2. First semester. Assignment 2, there. Okay, first semester, assignment 2. Obviously, the due date will be different. Sorry.
I think I sent you a tutorial letter. It's 001.
Oh, okay. Yeah. Let me close this. Okay, yeah. Here's the other one that you sent. So this one will have the updated dates. Yeah. Okay. Assignment 2. Due 26 July, so we're doing it much earlier than what's expected. Okay, July is way down the line. Okay, so you're definitely going to finish this ahead of time. Assignment 2 is out of 25. What else do they have here? Okay, let's just talk about the year mark. Okay, yeah, you do need all the units except unit 7. Interesting. Okay, so you didn't need the CGT. Okay, so then it might even be easier. If unit 7 is out, then this will actually be an easier assessment to complete because there won't be any CGT here. Okay, there's the SBC stuff that we looked at last week. And these are all deduction stuff that we looked at previously. Okay, so try it, see how you do. I don't see any CGT here. Okay, I do see capital allowances though. That's from last week. That's study unit 6. Okay, I can see here that you're buying a vehicle, you're bringing it into use. There's a new vehicle versus an old, etc. Okay, so I'll show you all the capital allowances again. We'll revise that. Okay, there's here's some wear and tear, writing it off over 3 years. Section 11, scrapping allowance. Okay, yeah, this is all normal deductions, eh? And that's it. Okay, short and sweet. All right, yeah. So I think for next week, try do assignment 2. It looks very short. It's just one calculation looking at deductions, working out income tax liability for a company. But notice this company is an SBC. So what tax? Oh, not. Oh, it's even easier. If they're not an SBC, there's no sliding scale. Do you agree?
Yes.
So I'm just going to be
Which is
using 28% tax. Does that make
20%.
sense?
Yeah. Yes.
Okay, because they're not an SBC. So you don't apply SBC. So you don't even need those other capital allowances. Yeah, so this is actually a very, 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 very basic example. It's generally just testing a normal company and calculating the deductions for it. Yeah, so quite a nice question. Basically, you don't even need, well, okay, you do need study unit 6, but you don't need the SBC stuff. You just need the normal deductions for normal companies. Okay. Think you can manage that?
Yes.
Yeah, so please rather focus on this. Try to do this for next week. And then if you've got time, then go back and look at those other activities 7.5, 7.4, 7.6. And then if you struggle with them, let me know that we can go through it in more detail if you can't work it out or if you don't know how they got the answers. For these ones, do we have answers for all of them? Let's check. Yes. Okay, it goes right up until the end. Yeah, perfect. Okay, that's good. Okay, Eunice gave you all the answers. All right, and then we can check them. So do it, check it, do it, check it, see how you do. If you don't know what's happening, let me know. We could discuss it and we can go through them in more detail. All right, but yeah, next week I definitely want to do the assignment. At least we've covered that. And then we've actually covered everything. Then you can tell me when you want to continue with past papers. Maybe we can do one, maybe, and then you've done one, and then maybe you could do others, perhaps, or we can leave them and then do them later. It's totally up to you, but you can think about it, and then you can tell me next week what's the plan. Have they given you an exam timetable yet for your exams?
No.
Not yet. Okay, so you might have to wait for that actually before you start planning. But yeah, you can tell me what works, and then we can decide after next week how we're going to run it. Okay, is that all right?
Oh. Yes.
Okay, perfect. Okay, then Cheryl, that's pretty much it for this week. Next week is assignment week. I will go through it in detail. I'll do it with you so you can see how I'm doing all the workings and calculations. At least then we can tick this, and then that's another thing done. And then we don't have anything else to do. Yeah, that's the end of the TUT letter. Awesome. Okay. Happy?
Yes.
Perfect.